value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He writes for the Financial Intelligence Report. He's speaking to us from the Bahamas. Welcome back.
Thanks for having me.
David, has Warren Buffett broken his piggy bank and picked out some change to buy something?
Yeah, I think that this is like a real interesting thing for a number of reasons. Number one, Buffett is not exactly what you would call, a gold bug. Actually, he was kind of infamous for calling gold like a pet rock. It's kind of sat there and did nothing a few years ago. And then, so obviously that means he probably sees something in kind of maybe the fiscal or monetary system going on, obviously with all this printing of money, huge government deficit, stagnant economy due to COVID and other factors. He probably just sees like this kind of going on for a while. And so that's number one. And then number two, there's actually three things to it. Number two is, it's interesting that he actually sold some banks too. He's been a long-term holder of like Wells Fargo and banks like that. And he sold some of those. And I think he looked at a lot of those banks, kind of his dividend plays. And by buying Barrick, he's buying a larger cap that actually pays some dividends. So it's almost like he's saying that he thinks the dividend is safer in Barrick due to, higher gold prices than it is a lot of these banks. So it's going to be tough for banks to make money. Even if the economy stabilizes, the issue with banks is, one of their main ways of making money is they borrow on the short end and then lend on the long end. And with like the long end rates being so low, okay, granted they can borrow at near zero, but the long end rates aren't anything. So they're getting like no spread on those two things. So, that's a big problem as well. For banks as well. So, and Barrick obviously doesn't have that problem producing gold, and the commodity that they're producing is going up in value. And then the third thing I think is key, that he actually bought a stock. If you go look at like a lot of these guys, these big hedge fund type guys, like who manage billions and billions of dollars, or mutual fund guys, when they buy gold, they tend to buy the GLD or the actual physical. I think that Kyle Bass, the famous hedge fund manager, owns a bunch of the physical himself. So that's another kind of key component to this, in my opinion, is that he went and bought a gold stock, and because a lot of the stock market has held up, and these tech stocks have done very well, we haven't really seen the move into the gold equities until just the last few days. Like we've seen them do well, but there still should be probably higher. With $1,900 to $2,000 gold and silver north of 25, you probably should see the equities trading at bigger valuations or higher prices than they are. So I find that interesting as well, because what I think, I've been talking about with Buffett here, is he's doing this sort of thing and in the equities, and that's going to bring in institutional money. So a lot of people are copycats of what he did. That's why you saw Barrick up 10%. The day it got announced that he took the position, even though he took the position back in the spring at a much lower level, because people are kind of just chasing what he does. And I think that kind of puts gold stocks on investors, scoreboard. And essentially, like a lot of people who would consider buying them now would. So you kind of get that institutional money and that retail money coming into the sector. And if you go look at like the weighting of gold or precious metals, it peaked around 2010, 2011, right when the gold market peaked, and a lot of institutions were up to having 7 to 10% of their investment weighting in precious metals, and that fell to a couple percent the last few years. So, and it's still there even with this recent rally. So I think we have room for those individuals to kind of continue to get back in, So I think that's all around, that's all positive stuff. And like I said, I think the key for myself, who does a lot in the gold and precious metals arena, especially in the equities, that can drive money into them. And I think even the CEO of Barrick said something to the extent that half the resources that have been, drilled over the last 10 years, of the resources that have been drilled the last 10 years, only half have been replaced via exploration, etc. So you're going to need a lot more exploration to kind of replace the gold that's been mined and that sort of thing. So you're going to need a lot of money in that sector. And maybe this is kind of, the kick in the butt the sector gets for the equities to really go. Because I'm just telling you, like, for example, the GDXJ, which is, the junior gold index, this index is over 50% lower than it was at its all-time high in 2011. And, of course, gold is actually higher than it was in 2011. So that just shows you how kind of, how beat up these gold stocks are and how they're nowhere near their peak levels of all those years ago. Now, there's certain reasons for that. Costs have gone up, so it was more profitable to mine gold at $1,800 in 2011 than it is today because of inflation. And a lot of these companies issue stock and dilute, so they may have a lower price, but not as a lower market cap because they have more shares out. But still, 50% lower means these things are trading at quite a big discount to they were the last time the gold and gold stocks peaked. And I think, like I said, I really believe that this could be the catalyst for people to move into the gold equity.
We'll have more with David Skarica right after this.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Welcome back. We're speaking with David Skarica. David, is one of the reasons why Warren Buffett sold some of his banks is that interest rates are expected to remain very low for a long period of time?
Yeah, I think that's one of the reasons that he did sell one of his banks, because, like I said, now let's switch to the banks. Well, why are gold stocks good investments right now? And gold stocks are not the best companies in the world. It's a horrible industry. It's a million things that go wrong. You're dealing with politics. You're dealing with costs. You're dealing with, all these, you can have a rock fall or an event happen at the mine. So you have all these things that can happen. And then, and some stuff is related to the mine, and then some stuff related to kind of the macro behind the mine or whatever, or the whatnot, right? So, anyhow, so when we think about this and all this sort of thing and what's going on in the gold and precious metals arena, so let's look at, the banks on the other hand, and the problems you have with the banks. Now they're problematic. It used to be, having a bank was like printing money. These banks all have big fees and they have this and they have that and ways to make money off us consumers. But the issue is, like I said, they're number one. The two ways they're going to make, a lot of them make money is by originating like credit cards and mortgages and debt-based stuff, and of course collecting the interest off that, and then themselves they borrow low, on the short end, and then loan those things out. Like they're even showing, for years and years, all of us have gotten those credit cards in the mail. They may just be those cards at a small, limit, like a couple grand, but they're almost like sending you a credit card to use, and then to build up credit and actually make that a larger, limit. And now they're actually, the number of credit cards is going down because of the weak economy. The banks don't trust, people who don't have jobs and no income to have credit cards. So that means less debt. Of course, those credit cards have huge interest payments. There's nearly $1 trillion credit card debt in the United States. So then that goes away. And then, like I said, the mortgage debt is $1 20 years ago when the dot-com bubble peaked, a 10-year mortgage was 6 or 7%. Well, now it's like 2 or 3%. So the thing is that they can't really make money off that, right? So, they can't make money borrowing on the short end and loaning at the long end because there's no incentive. So I think you're going to see less mortgages originated as well because there's not really the financial incentive combined with the fact that you're in this porous economy, right? So
we'll have more with David Skarica right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Aven, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, oil seems to me has been unusually strong. Is that because of the blockade of the oil ports in Libya?
I think the supply coming off the market in Libya is one reason. Actually, there's been a lot of supply come off in the United States. And again, it kind of has to do with this credit that I'm talking about because the economy is weaker and banks are lending less. Like what happened to a lot of the frackers is they were kind of almost, in my opinion, I've never been a huge fan of the fracking boom. I don't think it's some revolutionary thing that, made the U.S. Energy independent. I think it was all based on cheap money, like Jim Chanos, the famous short seller, says that fracking is really a financing scheme, not a business model. So a lot of you, even with, oil kind of rebounding to 40, you're seeing a lot of like fracking production come off the market because all of a sudden these fracking companies can't get access to debt to just continually like frack. And because I guess now banks or lenders actually care that they might be cash flow negative or they might be, unprofitable, etc. Right? So, that's something you have to kind of look at as well. And, with the production coming up, I think at some point the U.S. actually surpassed Saudi Arabia as the largest oil producer in the world during that kind of fracking boom. So that's coming out the market. And a lot of it's just money printing, right? Because you have money printing, which is, can be seen as inflationary, and that's kind of propping up, this oil market. And remember, like when we had that negative print on oil a few months ago, that was like really when, even though we've seen the surge of COVID in number of cases in many countries, we're not seeing kind of the universal, global economic shutdown that we saw back in March, April. We're seeing economies maybe they're not be fully open, but they're somewhat open. And I think that too, with, a little bit of a rebound in economic activity also kind of helps the oil price as well. Now, I don't know how long that will last and if oil might go have one more flush down into the 20s to kind of maybe shake even more of the high cost producers out, and that could be the final decline to kind of end this bear market. But I don't think we'll see that negative print again. And I think you are seeing a shakeout of kind of the weaker hands in the oil market. Now, if we were to go down in that 20s, I do think that's definitely a buying opportunity. I think oil is kind of where gold was, in 2013, where you just had this bust, and it might take a few years for it to shake out and bottom out, but you're probably okay to start to edge into the oil and gas market.
Are there other sectors you're taking a look at right now that perhaps others are ignoring or not paying a lot of attention to?
I don't mind, the marijuana sector is busted. I don't mind a few, but I think they have to be very company-specific plays, not a macro play. But I do think the one macro factor with that is, I think no matter who wins the election, it'll be more obvious if the Democrats had a sweep, landslide. But even if that doesn't happen, I think more than anything, what's going on is, with all this, in terms of, the markets, in terms of, marijuana is, if the U.S., I think the U.S. is going to legalize just because they have such a huge debt and deficit problem, that they're going to want another source of revenue. So usually when these countries kind of start legalizing, the vices, the gambling, marijuana, prostitution, whatever it may be, it's really just looking for a revenue stream, right? Because, they're looking to tax kind of everything because, they've kind of run out of things to tax because they're basically broke. And what's interesting about the U.S., and this is probably, if I want to segue into, from kind of, so anyhow, sorry, with marijuana before I segue into this last, point, I think you want to look at the U.S.-based plays, like the companies that are producing in the U.S. and that could benefit from that rather than the companies in Canada. And I think like the Canadian plays, though, is it's very difficult to make money in marijuana. The margins actually aren't as good as people think, et cetera, especially on the growing side. So probably if they do legalize, you'd want to sell, a few months afterwards into the news. And then you're going to see the kind of problems exist with production and getting cash flows and profitable, et cetera. So that would be it. So in terms of the U.S. as well, and one reason I'm bullish on commodities, I guess commodities would be another thing too, is any dips in kind of agriculture commodities or the whatnot, I think would be good because I think on any rally in the U.S. dollars should be sold is that what people ask me, why is the U.S. dollar starting to roll over? And it's quite simply, in my opinion, it's debt. If you go look at the actual numbers, if you combine, for example, in Canada, all the debt to GDP of the provinces plus the federal government, it comes out to about, I think, 90% of GDP, and this is after everything right now, right? Federal government's about 30 to 40%, and then the provinces add about another 50% all put together. Or in the U.S., the combined debt to GDP of the states, local governments, and federal government is over 150%. And that's like Greece, like Italian type levels, and, these companies that have real issues with debt. So I think that's one reason is that if you go look at their actual stimulus in the U.S., and the way that they've spent, everybody is doing it, we know, but the U.S. actually, in terms of the raw numbers, is being much more aggressive, probably because they think they can do it because of the reserve currency, in terms of blowing up their deficit and debt. And I think that relative to the other countries is why you're starting to see some pressure on the dollar. And really, if you go look at all the economic performance of anywhere from Japan to Sweden to Canada to the U.S., they were all about the same in the second quarter. They all annualized. GDP fell, about 30%. Of course, that's probably going to be low for the economy, but again, the U.S. is falling just as much as anyone else, roughly, with them spending way more than anyone else. So that's kind of a real negative, I think, going forward. And I don't really care that you can borrow that money at zero. History has shown, Japan is the perfect example of this, that even if you're not racking up huge interest expenditures, once you got a debt-laden economy like that, it's very difficult for GDP or the economy to grow. And I think, actually, if you go look at kind of like in the industrialized world and large countries, 3 countries that were examples of this are Italy, Greece, and Japan. All of these countries are those countries that have debt to GDP of well over 100%. And all of those 3 economies have had trouble growing for years, especially the last decade. So I think the Americans are about to actually fall into the same boat. And the one thing we just don't know with the reserve currency status is how long will the world support that? For example, the debt to GDP in the UK got to about 150% after World War I, and the world was willing to support that until the mid-30s, until World War II, because the UK was the dominant, superpower in the world. And then actually, obviously after World War II, they had to gut the empire because when their debt exploded even more, I think it was like 300% of GDP by the end of World War II, that was just too large and they could not support the empire anymore, and no one would keep buying British debt to support that. So I think at some point, we just don't know. Is this the equivalent of World War I going on, and the U.S. can still, live out another 10 or 20 years? But it should be noticed too, it should be noted from the end of World War I to the Great Depression, the British economy badly lagged the U.S. economy during the Roaring 20s. And that debt was a big part of it. And that could be the same thing with the Americans here, that even if people are willing to support them as the reserve currency for another 10 or 15 years, well, because of their debt load, they might start really underperforming Asia and other emerging markets. And by the way, that's another long-term investment theme I like. But of course, with everything kind of being inflated right now, it's tough to chase that. But definitely on pullbacks, or if there's another leg lower in equity markets, I'd be looking at buying Asia and the emerging markets over the developed markets.
David, thank you so much for chatting with us.
Thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter, online at addictedtoprofits.net. If you have any questions for David or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.